Welcome to what we think is a very timely webinar today on private assets within DC plans. Very important topic. We'll cover a lot of things throughout here. First and foremost, get it started. I'll kick it over to Sean for a quick intro of himself.
Sure. Thanks, Michael, and happy Tuesday, everyone. So Sean McCaffery, principal at the firm and a member of our manager research group. Been at the organization for coming up on 12 years now and helped to lead the diligence efforts on solutions or products that are unique to defined contribution plans. Michael.
Perfect. And thanks, Sean. My name is Michael Sustarsic. I'm partner and research director here at the firm. In the role, similar to Sean has his specialty. I've got mine and oversee and work within our private markets group across private equity, real assets, and private debt. So as we get into things, I think Sean kind of why don't you lay out the agenda for us today.
Yeah, perfect. I think just a level set on agenda and certainly operations. I think Michael, when we were kind of dabbling with this idea, we were discussing slides, presentation format, and I think we landed on discussion probably being the best at this juncture for this topic. The unmute function is turned off, but the chat box and question box should be available, so certainly hope to get to those at the end of the discussion. So just a level set with agenda. I think a few main points here. This has been a buzz topic, particularly the last year, 18 months. Certainly hope to hit on maybe some of those drivers or some of the rationale behind that. Certainly want to discuss what some of the low-hanging fruit or maybe clearest paths forward for integration of these solutions in defined contribution might be. And then, of course, hit on maybe briefly some plan sponsor level considerations for it as well before wrapping up with answering some questions. So with that, Michael, obviously this has been a focus, if not a fatuation of the marketplace for DC for the past year or two. Been a lot of interest both from plan sponsors, record keepers, asset managers alike. I think there's a few drivers for that interest lately, but maybe you can kind of share how we got to this point in time and why that interest might be so high now.
Yeah. I think very important to say how did we get to the spot we are and kind of what set the stage for us to do that. I think as you sift through the market, there's a couple of longer term trends that have been in place for a long time, continue to gain momentum, and then a few kind of like acute events that have really paved the way for providers and everybody to start talking about this a little bit more. So first on those longer term trends, I think recently broadening access to private markets has been a key topic of discussion. As more and more folks who kind of come down different structures that are available today are vastly different than what they were 5, 10 years ago. And so the availability broadly has brought private markets just more into the centerfold or the front page than it historically has been. Another one we look at is the performance of the space. Like, it's been good. Historically, it's exceeded public markets returns. If it was poor and no one was interested, I don't think it would be a topic that we're talking about today, but it has been good. We don't have a crystal ball to know if that will continue to hold in the future, but that is certainly probably the longest remaining driver in what's leading to the discussion today. And then we've also got past precedent really with retirement plans being pension funds, corporate, state, municipal plans, all having access to the space historically, and at times like being very heavy investors in the space as well. So those are kind of longer term market level trends. And then a few of the more acute events that have happened over the years. Most recently on August 2025 executive order really helped pave the way or give guidance to, hey, regulators, like make it a little bit easier or give us some guidance on easing the burden or just making it a little bit easier or clearer, so that these types of assets could be added to defined contribution plans. But I think probably the seminal event, if we roll a clock back, was really a DOL guidance letter back in 2020, that probably a little more paved the path of everyone being able to like pick up the pencil and start to make some plans for the space. So in that guidance letter, really talked about, and effectively the punchline was, you're not violating any ERISA guidelines if you include private assets in your 401k plan and your defined contribution plan. And so that was really the point where it's like, okay, everybody can start doing homework, putting the chess pieces on the board, if you will, to think about how this potentially gets included into the future. Um, we actually wrote a paper. If you dig back into the archives, it's probably still in existence there around that time. And it lists like, hey, here are the benefits, and here are the 10 practical things that we'll have to overcome from an implementation standpoint for this to be real. And we're finally getting to that point where a lot of that has been solved. And I think you, Sean, you've had a lot of conversations with managers in this space as well, coming to a head on like where this potentially fits within the defined contribution space. So it'd be great if you just kick it back to you and share a little bit on just kind of where the industry is moving and seeing this as the best fit within plans.
Yeah, happy to. I think the title of this webcast probably gives it away a little bit. I think we see the clearest path forward being under professionally managed solutions, so namely target date funds or managed accounts. I think the landscape or the industry at large believes that to be the easiest path forward as well. We certainly would agree with that. I think some of the concerns around maybe having these types of structures or solutions in a core menu standalone type of environment might just be simply misunderstanding by participants of exactly what these solutions entail. And anytime you have kind of misunderstanding, uh, on the behalf of participant, right, there's also the fear, the worry of misallocating to that solution. So I think professionally managed solutions is going to be the next wave of where we could see adoption for private market exposure. The two main structures I mentioned being target date funds and managed accounts. So for managed accounts, most of the large providers have long had the functionality to incorporate building blocks that did not reside or sit within the core menu. So think of a asset class or an investment that is basically invisible to the participant for a direct investment. That said, I think at large, the marketplace, despite having that functionality, typically doesn't take the managed account provider up on that flexibility or functionality. Few reasons might be driving that. Certainly, fiduciary committees still have to sign on for fiduciary responsibility and monitoring of that building block, even if it's not available within the core menu. And I think some plan sponsors might simply be thinking that maybe the juice isn't worth the squeeze, right? We largely see participant adoption of managed accounts sit between 5 and 15%. And so maybe plan sponsors think it might almost be more burdensome to have to add an additional building block and maybe try to prudently document why they've chosen that for a managed solution while not offering it directly within the core menu. I think the more common or more likely path is going to be within target dates. So unlike managed accounts, we see this adopted at a much higher rate by both plan sponsors and participants. I think there's going to be a few paths forward for the target date industry with these. We certainly could see new entrants to the marketplace. So new providers or asset managers that might not work in the target date space today think that could face a little bit of a headwind. It's been a historically difficult space for new entrants. We see roughly 90% of target date assets residing with five asset managers. So I think it's going to fall to some of these other paths forward, which would be current target date providers, whether they look to incorporate private assets within currently available solutions, or if they look to launch a new solution that might be built off the chassis of an already existing target date, but again, would incorporate some of these private assets. Some pros and cons to both of these. Obviously, if you're launching any new solution, there's concerns surrounding track record, assets, client concentration. And so that could be difficult. I think the other piece might be from a legislation standpoint or litigation risk, I mean, with regards to we've seen historically surrounding target dates, if a target date family has multiple offerings, there can certainly be environments where maybe the more expensive, say an active versus passive, a more expensive offering is at least in a short-term period underperforming a lower cost passive equivalent that has become a target from plaintiffs' attorneys for suits there. I could see that taking place within private markets and target date here, right? So if we have a target date product with no private market exposure, that might be cheaper because it doesn't have that private market exposure. but is also outperforming the more expensive one? Could that be placing a target on plan sponsors' backs for those that do have the underperforming, more expensive equivalent that does have the private market exposure? For better or worse, I think we see a lot of litigation risk really driving what's taking place in the marketplace and certainly adoption. But that said, I think those latter two paths with target date are probably the most likely step forward here. But maybe taking a step back, we've kind of broadly said, Michael, I think in this discussion, private markets. That said, there's a number of asset classes that would reside within private markets. I think all have unique aspects to it. Maybe we can hit on what some of those are.
Yeah, absolutely. And so as we think about, I'll call like the buckets or asset classes within private markets, largely I can just mirror what's there in public markets. So as we think about private debt, private real assets, and then private equity, inclusive of both buyout and venture capital. I think in target date today and even in some standalone options, we've seen some private real estate work its way into the fold, and maybe in some mixed experiences there, as I think there's also been some standalone options in that space. I think as we see kind of a first move into kind of the target date and managed accounts, and some of this is discussions with managers and kind of where they're seeing things today as well. I think it's very likely to be private debt. There's a few reasons. I think it makes a very natural first entrant into these plans. I think first and foremost, it's probably a little easier to understand the nature of the market than private equity or venture capital or even some of the more esoteric real asset spaces. A little easier to deploy in terms of lending. It's very active and growing market today. Again, it's broad in its scope in terms of just dissemination of information into the market there. Not nearly as much variability in returns, which candidly can be a good thing if you're a target date provider and trying to model for potential returns. Not as much variation from kind of like top to bottom or top quartile to bottom quartile as there are certainly in those other asset classes. And then lastly, it's largely self-liquidating. So you're a lender, private lender, you have a loan, it's due in 5 years. And so in 5 years, you have a maturity date where that loan is supposed to get repaid. You have income distributions along the way. And so it actually could help from just a naturally liquidating standpoint versus other asset classes that are maybe longer dated and thinking venture capital and the prevalence of companies to stay private longer. Like it may be harder to get that liquidity rebalance. And so, I think over the long term, as we've talked about this, you probably have all the asset classes work their way into the space, but it's not going to be all at once. And so I think like it's more of a crawl, walk, run approach as opposed to get everything there and kind of we'll figure it out as we go. I think the industry overall, and Sean and I have felt this, if we'll get on a call with a provider or manager and we'll ask some questions and they ask as many questions back to us to get intelligence on what the rest of the market is doing. So the industry, I think we can tell from that wants to move with some level of uniformity here, given such a big and transformational topic at hand. One of those big topics that inevitably comes up on both sides of that equation is really fees. I think very notably private market fees and public market fees, and particularly in the space of defined contribution, probably couldn't be farther apart, honestly. Some of like the highest fees that are out there, and then some of the lowest fees, very intentionally. And so, Sean, as we have had those conversations, and you think about fees and that being just such a focal point of this space today, how are those target date managers, those managed account providers thinking about kind of managing the all-in fees of the program and specifically just kind of, I don't say like battling with the fees, but the higher fee load of private markets?
Sure. I mean, obviously a massive consideration, right? It's difficult to get through any quarterly meeting with a plan sponsor at this point and not have fees be a large topic of discussion. I think taking a step back, so broader target date managed account universe, we've seen pretty widespread fee compression across the last 5 or 10 years. Part of that has been simply the assets that have flown there, the economies of scale from those providers. I think the other piece is going to be just the focus from plan sponsors, certainly litigation driving some of that. But fee compression is certainly something that I think all providers are very cognizant of right now. That said, and Michael, keep me honest, I would say all else equal, we would expect private market securities to come at a higher expense point than publicly available or publicly traded securities. So certainly something that providers and target date managers need to be mindful of. I think we've seen a few products from the marketplace in the last year or two, so generally still infancy stages, but I think providers are really struggling with whether they are going to be comfortable with increasing the fee of the target date solution to incorporate privates, or if they're going to be able to either uh, take a little bit of a profit loss, or B, be thoughtful in some of the sourcing, right? So if they were to source a private market exposure from maybe more expensive, esoteric areas of the public markets? Could they get kind of close to the same fee point for participants? Um, I think for defined contribution plan sponsors that maybe haven't had experience with private markets, maybe they don't sit on committees overseeing other institutional pools of capital, right? I think there's been a desire within defined contribution to have explicit fees, right? Transparent fees for both plan sponsors and participants. And I think the DC industry at large has really gotten to a good place on that. But Michael, obviously, private markets are a little nuanced. Explicit fees might not always tell the whole story. I guess, could you share some color on that?
I definitely wouldn't describe the fees as explicit, particularly in the way that you're thinking about it. And I think it is a big bridge to get across on that front. And just thinking about the layers and the different ways fees are charged and offset in various ways as well. So if you start to look under the hood and all is transparent, nothing is hidden, but it's not as seamless as, hey, this is the cost and what it is. So probably the biggest one is just performance fees across the industry. Like, it is probably the biggest driver of ultimate like fee revenue or earnings for the managers in the space. Oftentimes we'll actually see organizations that run their organization at break even, and then the profit is the performance at the end of the day. And so that's a big one to bridge there. And just what does that look like kind of as you parlay? Because that's by nature just variable based on how the performance goes. But even under the hood, like you start to look at things like acquisition fees, disposition fees, and debt, there's typically amendment fees and or monitoring fees. Each fund can be a little bit different, or each organization, and do these flow through to the end investors? Are these captured and offset somewhere else? And how that's done. So I think that's something that will have to be figured out and determined over time, and potentially benefits providers if they have something in-house. They have kind of that asset management or an investment function in-house versus having to partner externally, and a few less legal agreements to get through. But yeah, I think it's something where probably there's some uniformity in across and what's figured out. And I think at the end of the day, there are groups that are pretty good at figuring out like what you're ultimately paying. And if you're lacking the explicit kind of nature of that, and the transparency that's needed, you're probably more likely to find yourself in trouble down the road. I think like even with the fees and as we talk about things, it's almost always viewing things on a net of fee basis, in terms of kind of what is the end result for the investors who are owning these. And so I think that's probably a big topic is we've had discussions on all sides here. But just how the impact of including some of these asset classes is going to impact the outcomes for participants at the end of the day. So if I had 1% into private debt in my target date account, it's probably not going to do anything. But Sean, maybe you can speak to just the magnitude of how you're seeing kind of outcomes shift with the inclusion of certain asset classes. And then also too, I think kind of where groups have targeted that being impactful. Like 1% is not going to do it, 50% probably too far. There's a lot of space in the middle there that they could cover, but maybe you can touch on that just a little bit.
Yeah, I think that's a great point. Obviously, it's going to be provider specific, certainly asset class specific, right? Obviously, you mentioned earlier the different buckets that fall within private markets, the nuances, and certainly expectations of each of those asset classes. To your point, I think sizing is going to matter, right? I think we are seeing some providers view this as something they're going to dip their toes in, maybe a more modest allocation, call it 2, 3, 4%. Then we've seen others that I think are looking to take a more material look at it, think maybe 10 or 15% of a target date portfolio. Obviously, where you fall in that spectrum is going to have some different impacts. Certainly, pros and cons to it is obviously going to be the rebalancing and fee component of this. As you mentioned, right, these aren't fully liquid solutions, and so that's a operational consideration as well as one from a fee standpoint. The other piece is going to be, as you mentioned, on what are we ultimately expecting from an outcome perspective for participants. And I think it's going to be twofold. And again, depending on provider and asset class, the primary kind of objective of this might look different. I think for many, it's going to be, to your earlier point, it's going to be a return outcome, right? It's going to be one where we're expecting a high return, all else equal. To your point, historically or empirical evidence would show there is opportunity for private market assets to outperform public market. I think the other piece is, and maybe isn't talked about enough, is going to be the risk expectation. So we can talk about improved outcomes, not just from net of performance or net of fee performance, but also the volatility that participants are experiencing during the time they're investing. So maybe with that said, and I know this is sometimes a unique kind of characteristic of private markets, but a lot of managers are really referencing kind of dampen volatility expectations due to the incorporation of these diversifying private market asset classes. I guess why might that be such a solution for that objective?
Yeah. I think there's a nature within private markets of the volatility that exists versus the volatility that you feel. These assets aren't priced daily, they don't trade daily, so there's not a prevailing price for them on a regular basis where you've got thousands, if not hundreds of thousands of buyers and sellers every day. And most of these transactions take 2 to 3 months to actually unfold. And so I think the information level is high, but the frequency in which they're valued is not. And so even if you move them or try and price something daily, which you would naturally have to within a plan like this, it's not going to move with the volatility. And so the conversation is a little bit philosophical in some ways of is it a feature or is it a bug of the system? In either respect, it is just kind of the nature of the space and something that folks will have to get comfortable with. The obvious trade-off is the liquidity and the accuracy of that pricing. I mean, it can be modeled and audited, but at the end of the day, like that doesn't always have to hold and things can kind of unravel, particularly when we're talking like liquidity at a underlying like borrower, can dry up relatively quick. So I think there's a lot in there to unpack and at time will tell how that's felt and how that's viewed broadly by the market and regulators alike. So that is certainly an important aspect. As we get, have 5 or 6 minutes left here, want to maybe transition to questions because we've got quite a few lining up in our queue here in the chat. Feel free to keep submitting there. We'll get to what we can here, and then what we can't get to here, we'll reach out directly with answers. One of the things that's asked kind of in a few different ways here is just maybe summarize just how many plan sponsors are like on their front foot and adopting this so far, knowing it's new, but how many are out there kind of adopting this right now? And Sean, maybe I'll lean to you for the answer on this one.
Sure. I'd say in the DC landscape, it's minimally adopted, right? I think we're in the true infancy stages of it for a couple of reasons. I think some of the products that we mentioned within a managed account or target date setting are just being launched, right? There are a handful in the marketplace, a handful of other asset managers that have kind of noted that it's a research and a research focus for maybe the near future. Um, Earlier, Michael, you mentioned obviously we saw some guidance and some outlook from Washington that has been delayed a little bit, I think, by the government shutdown. I think overall, plan sponsors are just kind of patient with these solutions. A lot are kind of uncomfortable, maybe being early adopters. I think some of that might be from a litigation perspective, particularly since we haven't gotten a ton of guidance out of Washington. The other might just simply be from typical kind of monitoring selection that we'd like to see on any investment in a DC menu. As I mentioned, some of these solutions are so new, so we kind of want to see a track record and some assets flow into it. We have referenced on this discussion, right? Private markets have pretty good historical returns compared to maybe public markets, but some of that is kind of back testing or hypothetical. And I think plan sponsors and maybe the advisor community at large would like to see some actual returns and dollars flow into these solutions before they view it as a prudent investment for their clients to add.
Perfect. Another one we have here is just on structures being proposed that would be utilized under the hood. Sean, correct me if I'm wrong here, but it seems like CITs have been um, the common vehicle in which and how these will get implemented on the target date and managed account side.
I think that's right. I think we've seen a proliferation of CIT utilization. I think within target dates, CIT assets actually has now surpassed 40 Act mutual funds. And in discussion with asset managers, it seems to be CIT is going to be the vehicle kind of structure for this. But maybe I guess I could view that question another way is kind of under the hood, what are the structures of these? Are they evergreen GPLP? I guess, do you have a sense for that?
Yeah, yeah. I think there's probably more nuance under the hood than at the top level, but I would say the most widely and commonly used vehicle today is a drawdown vehicle that is a limited partnership. General partner of that is the fund manager itself. All the investors are limited partners there. That structure is incredibly common in the drawdown closed-end vehicles. It's also common in the open-end vehicles as well that exist, but you're also seeing more evergreen or open-ended options that are coming out today and more regularly, whether that's a BDC, a business development company, interval fund, or some other sort of tender offer fund. So there's been a lot of innovation in terms of structure, and I think that it probably lends itself a little bit better to fit within this and the requirements that are needed from a evaluation and kind of allocation standpoint for these types of pools of capital. All right, looks like we got time for one more here. This is going, and Sean, I think probably great for you to chime in on this, but just how should committees be approaching this from a governance standpoint? Frankly, regardless of if you include it or not, because there might be risk on both sides of that, including it or not including it. But just from having the conversation, making sure you're talking about it, what would you suggest, early days here on is the best way to approach that.
Yeah, I don't think there's an absolute need for plan sponsors to add something or a solution that has private markets at this point in time, right? There's no need to chase kind of the shiny object. As I mentioned, it is infancy stages. We are just starting to see products and solutions come to market. But like anything within DC and particularly ERISA, right, I think it's going to revolve around having a prudent process in place for selection and monitoring. And then, of course, making sure you document that. At large, I still think that this is a component of target date, but certainly shouldn't be the main driver for target date or managed account solutions, right? The ability to incorporate privates. All else equal, still think probably the overarching equity versus fixed income allocation, right? So the glide path of these solutions is going to be one of the key drivers of both return and risk expectations. And there's a number of other characteristics outside of just public market and private market exposure that plan sponsors and committees are kind of tasked with considering for selecting these types of solutions. It's an area that I think is going to continue to increase in terms of discussion and products coming to market. For our clients, they've probably seen it in our governance calendar the last few years as a development or trend within the QDIA target date and managed account landscape, and certainly one we expect to continue.
Perfect. Well, we're at time. We've got probably a few other questions that hopefully we'll reach out to folks directly on. Been great to have you with us today. I keep joking with Sean that we've got to spend more time together in meetings over the past 3 months than we probably have in the prior 9 years before that. Because of this, that'll certainly continue. Don't hesitate to reach out to either one of us or your consultant with any questions that you have. And I'm sure we'll be up here with one or two more of these before it's all said and done. So thank you for your time. Have a great rest of the day.